Robert, in your report today, you say another good jobs report keeps the Fed on track for a September rate hike. So what did the report tell us?
This report showed that we gained about 201,000 jobs for the month. Those are pretty good numbers. We gave a little bit of that back with June and July, negative revision of 50,000 there, but still an overall good month for August. And importantly, average hourly earnings are now up 2.9% year over year. And that's a key number that the Fed is going to be watching because they're keeping an eye on wage gains, wage growth, because that feeds into inflation. And that's really what they're focused on for the remainder of this year.
So what can you tell us about what you expect for the next Fed meeting?
Well, I do expect the Fed here in a couple weeks, September 25th and 26th, to go ahead with that third rate hike. Very widely anticipated, let's call it a near 100% probability that the Fed will go ahead and raise the Fed funds rate 25 basis points. And I think they'll probably also give us some indication, positive indication for the fourth rate hike this year coming in mid-December. So number 3 and number 4 all lined up, all teed up, ready to go. And then when we get into 2019, I think the Fed's going to have to break that cadence a little bit, and we'll have to see what happens next year. But I'm expecting 2 to 3 instead of the 4 we get this year.
Let's move on to the manufacturing numbers that we got this week as well. What can you tell us?
The ISM Manufacturing Index for August is a nice overall indicator for the health of that sector, up over 61.3, and those are robust numbers. And despite those concerns about trade tariffs and things like that, manufacturing is hitting on all 8 cylinders right now, and these are very, very good times for U.S. manufacturers. Employment growth was a little bit off here in August, but they've been coming off a string of very consistent gains. So employment is up, production is up, new orders are up. You can't argue with any of that.